Alright, let's jump into Chapter 2, Building a Trading Plan, and I'll break it down in a casual, relatable way so you can really get the essence of why having a solid plan is so important. The importance of a trading plan, your GPS for success. Imagine you're driving without a GPS. You're guessing where to go, making turns based on gut instinct, and maybe even getting lost along the way. That's what trading without a plan is like, super risky. A trading plan is your GPS for the markets. It's what keeps you grounded and focused, especially when the market gets wild and your emotions start running the show. Without a plan, you're just winging it. And when you're winging it in the markets, you're basically setting yourself up to make decisions based on impulse, rather than logic. A trading plan outlines your strategy, goals, and risk tolerance, so every decision you make is backed by a clear, thought-out process. Defining your goals. What's your endgame? Before you can dive into the nitty-gritty of your plan, you need to define what you're working toward. What are your goals as a trader? Are you looking for consistent small wins, or are you going for big swings in the market? Your goals are the foundation of your plan because they help shape the way you approach each trade. For example, if you're aiming for long-term consistency, your plan might include lower-risk trades with a higher win rate. But if you're aiming for bigger profits with a higher risk, your plan will need to accommodate more aggressive strategies. Defining clear goals will help you decide how much risk you're comfortable taking and what kind of trades will move you closer to achieving those goals. Risk management. Don't gamble, trade smart. One of the biggest rookie mistakes is not managing risk properly. When you're trading, you must understand your limits. It's not about trying to win every trade, it's about making sure your losses won't blow up your account. This is where risk management comes into play. Here's where you set the rules for how much of your capital you're willing to risk on each trade. A common rule is the 1% rule. You risk no more than 1% of your total trading capital on any given trade. So, if your account balance is $10,000, you're risking $100 per trade. This helps you survive the inevitable losing streaks and keeps you in the game long-term. Your trading plan should also lay out your risk-to-reward ratio. Basically, how much you're willing to risk to potentially make a profit. A good rule of thumb is aiming for at least a 1-to-2 ratio. That means, for every $1 you risk, you want to make at least $2 in return. This helps balance out the losses when they happen and gives you a better shot at profitability in the long run. Entry and exit points. The art of timing. Knowing when to enter and when to exit a trade is crucial. If you're unsure, you're going to end up in trades that don't make sense and potentially lose more money. A solid trading plan includes clear criteria for both. You need to know ahead of time exactly when you'll enter a trade and when you'll get out. Your plan should include things like entry signals. What indicators, chart patterns, or market conditions trigger your decision to enter a trade? For example, maybe you use moving averages, candlestick patterns, or support and resistance levels. Exit signals. These are the conditions that tell you when to take profits or cut your losses. Do you set a take profit at a certain level? Do you use a stop loss to protect yourself from big losses? Knowing when to exit is just as important as knowing when to enter. It's not just about waiting for the perfect setup, it's about having a defined process for identifying that setup and sticking to it. This removes any guesswork and emotion from your decisions. Paper trading. Test your plan before you risk real money. Before you jump in with real capital, it's important to test your plan first. That's where paper trading comes in. It's like practice for your trading plan. You use fake money to execute trades and see how well your plan holds up under real market conditions. Paper trading is essential because it helps you get comfortable with your strategy, test its effectiveness, and iron out any kinks before you risk your hard-earned cash. Even if you have experience trading, paper trading is a great way to build confidence in a new strategy or just get your mind in the right place. The psychology behind a trading plan. So, why is it that a trading plan is such a game changer, especially when it comes to your mindset? Simply put, it takes the guesswork out of trading. When you have a plan, there's no room for emotional decisions. No more, oh, I'll just enter here, it feels right, or I'll hold this trade because I can't stand the idea of losing. A solid plan helps you stay disciplined and focused. The best part? When you stick to your plan, you reduce decision fatigue. This is when you're constantly second-guessing yourself and making impulsive decisions because you're exhausted from thinking too much. A clear plan gives you structure, so you don't have to keep rethinking every single trade. Key takeaway. Stick to the plan, and the results will follow. At the end of the day, your trading plan is the foundation of everything you do. It's the roadmap that guides your actions and helps you stay consistent, even when the market gets chaotic. The more you stick to your plan and execute it with discipline, the more successful you'll be in the long run. The goal isn't to be perfect, it's to be consistent. To sum it up, plan your trades and trade your plan. It's that simple. If you've got a solid plan in place, you're already way ahead of most traders who are just flying by the seat of their pants. How's that sound to you? Do you have a trading plan already, or are you still in the process of building one? Let's chat about it. This stuff is crucial to your long-term success. See you in the next chapter.